All right, long time coming, Greg Foss. Thank you so much for joining us here on Money Talks. How you doing, man?
I'm well, thanks. Hey, I'm looking forward to this chat. It appears we have some similar backgrounds. So
Yeah, it's awesome. I love how all of a sudden fixed income has become super interesting, and people are starting to get that there's something amiss here with these so-called bond markets that the average Joe public just doesn't seem to understand. But those of us in the know realize actually leads everything else, right? And maybe start there. I've listened to you a few times on some Twitter Spaces recently, and I think you have some really interesting and very prescient commentary on what's going on. So maybe we could start with like the events of the past couple of weeks, right? We've had bank failures, the Fed has stepped in, Treasury trying to step in. Give me your bird's eye view of what the hell is going on.
okay, well, there's a lot there. Let's start with your observation that credit leads everything. And since we both have a history in the credit markets, and having lived through 4 credit crises myself, you can't argue with the fact that credit seems to sniff out things before equity, guys. Credit is staffed by pessimists, right? Because in equity land, trees absolutely grow to the moon, Bill, because, you know, the growth rate will tell you that a tree will grow to the moon. But in fixed income, and particularly credit, sensitive fixed income. So I had my career was in junk debt and distressed debt. Yep. You basically have a priority of claim over the equity, and you can therefore use the equity as a hedge, because if the equity has any value whatsoever in a restructuring, the rules are that your debt is worth 100 cents on the dollar. So you should look to the equity the debt as having a viewpoint as what the enterprise value is worth. Okay, without going too much further down the Finance 101 rabbit hole, having spent my entire life there, during the last serious great financial crisis in 2008, 2009, I cut my teeth in the credit default swap market, which is a very efficient market played by the big boys. You need an ISDA, as you know, and it's not for the small investor. Basically, at the end of the day, excuse me, of course, the phone would ring when I'm on the thing. It's not for the small investor. At the end of the day, this is a very sophisticated market where risk is traded in big size and money is made and lost. So it can typically give early warnings for distress in the entire capital structure. So perhaps you haven't been following me for too long, but I've been bearish on basically Credit Suisse for over 2 years. And my warning signal was a number of things, which included the small market cap of the stock relative to its asset base. And then all the problems they had, Greenhill and Archegos, and just poor risk management. But at the end of the day, the credit default swap market was predicting this for an awful long time.
When you say predicting this, you mean the failure of Credit Suisse?
Well, not just this failure, but the distress. And this is reflected. So we'll walk through this. It's reflected in a credit default swap, which is a spread, a risk spread, or think of it as an insurance premium, how much it costs to insure debt against default. And as that spread is increasing, you can think of it as an insurance premium that's increasing. And, you know, during the great financial crisis, let's walk back through that. There was rumors, and I believe this to be true, that if AIG had failed, the big insurance company, they had sold so much insurance. Now, not life insurance. Think about insurance with, looks like oh gosh. Okay.
It looks like I'm on mushrooms. Okay.
Yeah, there you go. If AIG had failed, they had sold so much insurance to Goldman Sachs, or alternatively, Goldman Sachs had purchased so much insurance from AIG, that if AIG failed to deliver those insurance rewards, Goldman Sachs would have failed. And that's absolutely true. Now, so this market is sophisticated, as I said, and it's levered as well. And that's what credit is. It uses leveraged bets in different ways to enhance returns. But as you know, leveraged enhanced returns also risks leveraged enhanced losses. So having spent my life there, you and I have been through, the credit pits, and you know how dog eat dog world a trading floor is. And oh my God, there's excitement, but you're really living real life risk share there. I just very simply look at everything through a credit lens now. And the big banks right now are in an extreme undercapitalized position. Why? Because all of the risk that they have incurred in the last 2 years has been because of interest rate risk, not because of credit risk. And they've lost a ton of money on interest rate risk, which they shouldn't have. They had mismatched assets and liabilities, all of which is to say the next shoe to fall is credit. And where you and I spent our lives, and you know how distressed situations get when credit counterparties don't trust each other and everything. So that's where we are right now. You're at a very, we're teetering on the head of a pin where counterparties are not trusting each other within the financial markets. And when that freezes up, the entire lubrication of the financial system stops. And I think that's why yesterday you saw Jerome Powell mention credit something like 10 times more often than he mentioned the word inflation.
That's right. He said something he hadn't said publicly before as part of his prepared statements, which was that the credit tightening itself can be thought of as the equivalent of incremental rate hikes.
Well, yes.
Now that's obvious if you work in fixed income trading or research like I did, but I don't think it's obvious to the public. So maybe elaborate on that point a little bit, because I think that it's almost like he's in his own mundane way ringing an alarm bell that we haven't heard before.
I agree with that 100%. And without getting too granular, it's the equivalent of when credit conditions tighten, it's less banks and institutions are less likely to lend, even at a higher price. Okay. Like in theory, there should always be a price, but the way banks work, it's like an on-off switch. Yes, I'm lending. No, I'm not lending. It's not like, okay, I'll increase the price and lend at a higher spread over the prime rate or something like that. It's like an on-off switch. So what I think Powell was saying is this increase in restrictive credit is the same as him raising, and I would say he said it was somewhat subjective and there's no hard and fast rule on it, but I would say it's the equivalent of him raising another 150 basis points easily.
Yep. Yeah, I agree with that. Okay, so obviously we've got this fastest credit tightening that we've had in modern recorded history over the past 18 months. The kind of consumer pop sentiment on all the closet economists here has been, okay, something's gonna break. Turns out it's the banks, right? But the talking heads perspective is, well, no, it's not the banks, because you had one really stupid management team that didn't understand the basics of duration and convexity, and you're shaking your head and saying, that's just not true. And I'm assuming that this is a very efficient way of saying it's a systemic problem, and he's full of shit. So let's go there.
Yeah, well, let's go there. Just look at the unrealized losses on Bank of America's balance sheet for the same exact thing. Interest rate risk mismanagement. Okay, borrowing deposits, not paying a very high interest rate or deposit rate, if any at all, taking those deposits and lending way out the curve in long duration treasuries, that when interest rates go higher, the price of the treasury goes lower. And all of a sudden you're at a mark-to-market loss on these treasury securities. But if you hold them in a specific account called held for maturity, you don't have to take that mark-to-market loss. So Bill, you and I cut our teeth on the trading floor. Imagine going to your boss and saying, hey, boss, everything's fine. I don't want to mark-to-market my trading losses because, I'm confident that they will mature over time, which is largely true in the case of US Treasury bonds. Not certain. Right. We could get to that point later. But the point is non-mark-to-market accounting in a bank, which is levered 20 times to its equity capital base, means that if their book changes by more than 5% in value, the equity is vaporized. And I've lived through that with the LDC debt crisis. You cut your teeth with the Brady bonds as well. This is 30 years old. And I'm a Canadian, but went to school in the USA, came back to work in Canada for the largest financial institution in Canada called the Royal Bank of Canada. My first project was the Brady bonds.
Oh,
And
wow.
I did a back of the envelope calculation for the CFO. I was working directly for the CFO. And I did a back of the envelope calculation. I'm like, holy smokes, Royal Bank of Canada is insolvent. And I went to the CFO and I said, Emil, we have a problem. And he goes, I know, don't tell anybody. Now, the good thing is I was 25 years old. No one would have believed me anyway. But the truth is, Treasury Secretary Nicholas Brady did not generate the Brady plan to rescue Royal Bank of Canada. Chase Manhattan, Bankers Trust, everywhere on Wall Street was in exactly the same position. Yep. They had made bad loans at 100 cents on the dollar that were trading at 20 cents on the dollar. That 80 cents on the dollar write-off would have vaporized everybody's book value of equity. That's called insolvency.
That's right. I mean, there was no concept of risk management back then. I mean, when interest rates were falling under Clinton, everybody was printing money, and then all of a sudden it went the other way, and everybody's so the other thing that I think people don't realize is that when interest rates are going like this, these unrealized, non-marked to market losses, they're not growing at a linear rate, those losses. You know, when you're dealing with the convexity of these bonds,
it's only math.
The kind of rates, it's your
well, it's acceleration. So for those people who love physics, of which I'm one, think of your duration as being your velocity and your convexity as being your acceleration. And when something's convex, it's accelerating losses to the downside.
That's right. So for the geeks out there, convexity is basically the first derivative of duration, and basically tells you the rate, the risk, the duration risk you're taking over time based upon the change of interest rates.
Beautiful.
And right now they're fucked, because I think that so many of these management teams don't understand what I just said.
No, you're right. Now, here's what I wanted to say. Okay, so, you know, they say it's one or two. Look, the Fed themselves said there's 100, or maybe it was a Wall Street Journal report, 186 other banks in the USA that are still in the same position as the regional banks. And that includes Bank of America. Bank of America would have to write off 3/4 of their book value of equity if they mark their held to securities account to market, which leaves 1/4 for credit losses, of which are going to explode if you go into a recession, which means, guess what? We're in an insolvent banking situation once again in North America and globally, by the way, because that's what always happens.
Right. Okay. So we're in less than violent agreement that we have a big problem, a systemic problem. Most banks are insolvent right now. A lot of the newfound insolvency being caused by interest rate movements, although we can make the case they may have been insolvent all along. Funny money printing, et cetera, et cetera. But now we've got this kind of consumer debt on top, right? We've got a whole bunch of people who took out probably variable rate mortgages at close to 0.12%. We've got credit card debt, which is being repriced on an as we go basis to the detriment of the consumer. And as far as I can tell, the numbers are staggering and growing. And so how do you think about the convergence of those things happening at the same time? And what's the end game?
Well, again, because we have just gotten the doors blown off from interest rate risk, and by and large, the capital guidelines set by the Bank for International Settlements are set for credit risk, not even for interest rate risk. So the banks got their doors blown off for a risk that by and large isn't even regulated, okay? Banks are largely only regulated for credit risk. So this is not a good time. You mentioned the consumer things. I actually think there's a bigger canary in the coal mine. I think it's the commercial real estate portfolios, okay? And the fact that cap rates on office portfolios have nowhere near kept pace with the increase in interest rates. So a lot of these office buildings are valued at levels that don't make any sense in a higher interest rate environment. So you're already seeing it in Los Angeles. A big Canadian property manager, Brookfield Properties, walked away from $2 billion office tower. Who do you think holds that debt? Well, it's either commercial mortgage-backed securities, securitized product, or regional banks or banks. So all this filters through the system. Look at credit default swaps on everything. Capital One Financial is a great idea right now. You can see Capital One Financial, which is basically subprime credit card exposure, is blowing out. And while Capital One is blowing out, it's blowing out way faster than American Express CDS is, because American Express is deemed to have, the higher quality credit, guys. At the end of the day, everything's correlated. And that's why contagion is the biggest problem in a system that's levered, because contagion leads to a domino effect that leads to, don't trust that guy. That guy, Bill, was a good counterparty, but I don't trust him anymore. Your credit risk officer comes down, gives you a tap on the shoulder and says, hey, Foss, you can't trade with Bill anymore. And I'm like, damn, Bill was my best counterparty. How am I supposed? Well, because we're worried that Bill's not going to make good on his contracts to us. So, hey, I've seen it before. It's a horrible situation to be in, but it is reality.
So what gives? I mean, let's play this out, right?
Yep.
So, the Fed may have given them more air, to lower a little bit.
To lower, yeah, sure, but certainly then all of a sudden you have inflation risk that hasn't gone away. Then you're decreasing rates to save for financial stability, but you have runaway inflation because the solution is always printing money, QE infinity. So I'm not sure, I followed your stuff. I'm not sure where you end on hard assets, if you're a gold bug but having spent my entire life in fixed income, I found Bitcoin in 2016, and I immediately thought of it as the solution to the fiat Ponzi that took me all the way back to my first job at Royal Bank of Canada, where I said, this fiat Ponzi thing is ridiculous. If the banks are regularly insolvent, how come they still have high credit ratings? Well, because they are too big to fail. And if they're too big to fail, they get bailed out by a country. And what can a country do? It can print money, which means the value of that money is debasing over time. So I'm a hard asset aficionado, if you want to call it right now, of which I do like gold, I do like commodities, but I really love Bitcoin, because here's where it comes. Bitcoin, I think of as credit default swap insurance on a basket of fiats, not just the US dollar, all fiats in the world. And there's no counterparty risk, Bill. This is the beautiful thing. This is my insurance policy, and I don't have to worry if the insurance company is going to be able to pay me back. Yeah. So that's why I love it.
So I agree. I've been, long Bitcoin for a very long time.
Attaboy.
So the challenge with government-backed Ponzi schemes, and I'll use your terminology, and Ray Dalio has his own terminology, which isn't as harsh, but it gets you to the same place, is that you don't know when the Ponzi is going to end. And so if you don't play the Ponzi game while it's being played, you don't have assets to put in gold in the first place, because you're not participating in the barter that it takes to get the cash to put in your gold. So there needs to be a transition, and people need to be able to participate. And we don't want the system to break overnight, right? Because we don't either. We don't want to be. I don't want to be the one house in Hiroshima that's still standing after the bomb goes off. I don't. Right.
That's an interesting analogy.
Now, give it a choice between being that house and being no house. I'd probably choose that house, but I still want that to happen. So let's assume that they can prevent that from happening for, I don't know, 10 more years or whatever it is, right? Yeah. What in your opinion is likely to happen between now and then, if you play it out?
So I'm a big credit guy. I mean, I just run the numbers on the USA, which is the strongest fiat in the world. There's no question. But I like to say it's the best looking horse at the glue factory, because all fiats are debasing. So this just happens to be the one that has it will survive the longest. Okay. So if you take the USA and you look at their debt situation, it is mathematically impossible for them to grow out of their debt. The interest expense on the debt is going to grow faster than the economy under any scenario. And that means that the debt is growing organically, regardless of whether a government comes in that adds to the current deficit with deficit spending. Okay. Yep. So you know that printing money is the solution, because otherwise it blows up. So sure. QE infinity is grade 11 math, which means as long as they can keep this going, The debt will, so USA has $31 trillion of debt, funded debt, and another 170 trillion. It's so mind-boggling, of unfunded obligations like Social Security. But let's just look at the funded portion. That's $31 trillion. 2 years ago, the interest expense on the debt was about 300 billion. What is 5%? Because that's overnight rates right now. 5% of 31 trillion. That assumes all the debt rolls over at a 5% rate. That's $1.5 trillion annually that you have to pay on interest expense. Now, the USA doesn't take in enough money after you subtract out military spending and Social Security. So,
and productivity growth is flat. GDP growth is flat. Population, we're not letting the immigrants in that allows us to grow.
So here's the thing. So what happens is hopefully that credit balloon expands because there's enough demand for US Treasury refunding. But it'll crowd out other demand for credit. So high yield bonds are going to be in really big trouble because high yield already is full of zombie companies that can barely meet their interest expense. Now, the USA cannot meet their interest expense, but it can print money. These guys can't print their own money. If they can't roll over their debt, boom.
Right. So theoretically, playing that out, just thinking out loud here. So if the Fed picks and choose, picks the winners here and then choose themselves by buying bonds, by buying their own bonds, but not by buying corporate bonds, now we start to see a massive spread.
Yeah.
Right.
And what does that do to bank balance sheets, Bill? Because then high yield spreads change to loan spreads, and loan spreads get marked to market in a trading portfolio, but not on a bank's book, unless there is a default event. And then they have to take it to the provisions for loan losses. And you know how the accounting works. It's just a gimmick. So I'm not bullish. In fact, I'm very bearish on the credit system. However, there is a way out because I don't want to be the last house standing in Hiroshima. I think there's a number of ways the US can address this. We could talk about that. But the reality is, as long as you print more money, you can keep the Ponzi scheme going. You just have to protect your net worth with assets that will appreciate in value when a money printer goes burr.
Yeah. Historically, the easiest way to, not easiest, I mean, because people die, but the most common way, probably not the easiest way, of delaying the inevitable has been, kind of war, because you end up in this wag the dog situation where you can rally the public around a common enemy. And, that's my fear here, because everyone gets it, right? China knows that they're sitting on our treasuries and nobody else wants to buy them anymore. And they may actually see this. I think you can still hear me, but
I can. Yeah, sorry, I just took the
so it's okay. Yeah. So that's my fear, is that the easiest delay tactic here is expanding wars, because and I just don't know that in the age of social media, my fears may be unfounded, because in the age of social media, it's going to be much harder to rally the troops than it was before, because people can voice dissenting opinions in a way where they couldn't in Iraq 1 and even Afghanistan, et cetera, et cetera. I don't know is the bottom line.
I really hope you're not wrong, but I hope it doesn't come to that.
Yeah. Okay. So let's talk about crypto and the divergence we're seeing. So I don't know if you have an opinion on this, but in the last couple of weeks, and I'll bring up the chart in a second here while you're talking, we've seen a clear divergence between Bitcoin. And we won't go to crypto for a second. Let's just talk about Bitcoin and everything else, right? I mean, I think Bitcoin and maybe Meta, right? Bitcoin, and I think that's just, I don't think there's any correlation between Bitcoin and Meta, but they both happen to be up about 70% this year to date.
Wow.
And
so first of all, here's where I am. Okay, so I'm a Bitcoin maximalist when it comes to digital assets, but I don't have all my money in Bitcoin. Yeah. Bitcoin is the only digital asset that solves the fiat Ponzi for two reasons. Firstly, it's the only true decentralized platform. There's no CEO. And secondly, and most importantly, it's the only one with a fixed definable supply. Okay. So not to point fingers at other, Ethereum, for example, but if you ask Vitalik, who is essentially the CEO, what the supply of Ethereum is, his answer is, well, it's difficult. I don't want, well, it's difficult.
Right.
I want to know that there's
Right.
only 21 million coins.
Yeah. When it comes to
Bitcoin.
money, I completely agree with that sentiment.
Yeah.
My interest in those things is because I'm a long-term software guy. That's a different discussion. Okay. So we talk about hard money. I'm with you. Where I diverge with some of our friends in the maxi world is that I don't look at that stuff as money. I look at it as decentralized software tests that may or may not work. And I've personally made a big bet that it will. If I lose my money, it's my problem.
Yeah.
And so, okay. So back to money though, but do you think that the divergence in what's happening with the price of Bitcoin is a function of everything we've just been talking about? Or do you think it's forward-looking expectations on quantitative easing that's to come?
A combination. And I don't know, but here's the craziest thing. I've always viewed Bitcoin as a risk-off asset. Because what is insurance? Insurance is a long volatility product. What is long volatility? It's things that will go up in price when the world is melting down. Okay, what happens with stock prices when VIX spikes? Stock prices go down. Yeah. If you're long something like insurance, in theory, it should go up in value when risk increases. It hasn't been that way historically because everyone's traded Bitcoin as a risk-on asset. I think they're wrong. I think Bitcoin's insurance. Therefore, I think it should always have traded as a risk-off asset, which is to say when things get more risky, the value of Bitcoin should go up. Is this why it's played out though, Bill? Now, come on. In the last 3 months or, 3 weeks, since the beginning of the year, it's been because of bank concerns, largely people taking their money and seeing that the credit or the fiat Ponzi, which the transfer mechanism is commercial banks, those are risky.
Yeah.
They're looking for alternatives. So it's a combination of both, but never forget the insurance, which I view Bitcoin as, and I can value Bitcoin using credit default swaps on sovereign debt.
My question, have you ever seen a chart on the correlation between CDS spreads and the change in Bitcoin price? Because I hadn't considered that until you just said that.
Okay, no, but I did research 2 years ago that basically proposed this. It was a 50-page research paper that sort of brought me into the scene. And I can value Bitcoin using credit default swaps on sovereign debt. And by the way, Bitcoin is stupid cheap insurance. So I like that valuation methodology. People can agree with it or not if they do. But most importantly, I think over time. Now, here's the crazy thing. I'm an Ivy League guy, so I'm allowed to say this. You're probably an Ivy League guy too, but I didn't.
No, not even close.
Okay, well, here's the crazy thing. So I'm an Ivy League guy. I can say this. Most algos that are programmed on Wall Street are programmed by 25-year-old Ivy League cucks that have just come out of school, and they look backwards and program asset correlation prices looking backwards rather than looking forwards, as they should. The difference is when that model breaks and people realize, oh my God, Bitcoin's actually insurance and it's got gamma. And we could get so technical about it. I've just never seen a better asymmetric trade opportunity in my entire career. And that's why I do own a portion of my assets in Bitcoin. That's it.
Yeah. And that's the technical explanation of that transition I was talking about with the Ponzi, right? Is we don't know, when you're riding it, everybody wins because that's the nature of the Ponzi. And it's legal because the government's doing it as opposed to Madoff or somebody else. And the question is when it stops and the musical chair stops, nobody wins, right? Neither Madoff nor anybody else. And so clearly, hard asset, whether
Correct.
it's
but we don't want this because you can have hard assets and then there's roving bands of people searching for food and there's absolute dysfunction in the whole world. Now, some of the Bitcoin maxis out there say stuff like this. The lion does not care when it eats the antelope. Okay. This is natural progression and you have to live by this. I think there's something somewhere in between, but I also say, damn, this is like you can see the forest fire coming across the valley and you're supposed to prepare for this, guys. It's that simple. If your eyes are not wide open to this reality, well, then you shouldn't be managing risk. And all we have to do is listen to people like, the talking heads within the IMF or whatever that just are paid not to tell the truth to people. So just get your insurance, guys. The only wrong allocation to Bitcoin is zero. Okay.
Zero.
If you're short it, then you're really a knucklehead, but I can't help you there. You might be a day trader, whatever, but long-term, over a period of 20 years, Bitcoin has a value of over $2 million per Bitcoin in today's dollars. That's my analysis. Send your hate mail to Bill. I've done the work. I'm a credit guy. I'm telling you, this is the best form of credit insurance I have ever seen, and no one's done the work on it. So that's where we are.
Yep. Wow. So how do you think about, well, you already answered my first question, which was time preference, or mostly answered it. And how do you think about allocation when you probably get a whole bunch of people because they see you, you talk about it all the time, who know you from TradFi. I get the same thing. What should my personal allocation be? And how do you, obviously it all comes down to personal risk and things like that, and it's a decision for themselves, but what's the logic that you would usually want to give them to help them think through their personal equation?
Okay, great question. So I like to start them at anything greater than zero is good. Let's try and get you to 5%. Okay. At any point in time, and you don't do it all in one shot. Why don't you take how much you would need to invest to get to 5% and divide that purchase up over the next 20 weeks. Okay. So every single week you buy the same amount of dollars worth of Bitcoin. And if the price has gone higher, you're getting less Bitcoin. But if the price has gone lower, you're getting more Bitcoin. So that at the end of that 20 weeks, you have a 5% exposure. So stick with me here. 5% exposure. It's like these people forget what happens to the other 95%. And they're just zoomed in now on this 5% exposure because it's a new thing, right? And they're like, oh my God, it's gone up and down. I'm like, guys, this is for the next 20 years. You want this 5% exposure. So I think Bitcoin goes up 100-fold in value from here, 100 times. That 5% over the next 20 years is now 500% of your portfolio. There's where you start managing risk, okay? Because if information changes, you change your portfolio allocation. But don't forget that the 5% is insurance against all this other 95% that you have over here that really is risky, okay? Because if the banking system does fail, I promise you this 95% over here is exposed to tremendous amounts of risk. You just might be comfortable because you've always grown up having your money in a bank, for example. So that's portfolio risk analysis, risk. And by the way, I will never tell anybody to put 100% of their net worth in anything. That's not the way I manage risk. So there are out there Bitcoin maxis that say you're a knucklehead for owning anything besides Bitcoin and 3 months of fiat to live. And I'm like, well, you don't live in a house? Yeah, I do, but I rent. Well, I don't rent my house. I actually own my house. And I include that as a lifestyle choice. So Bill, you talk to high net worth individuals. These are the people that understand how to manage risk implicitly. They've done it because they've built businesses or they've taken risk and have been rewarded. This is so important to get everybody off zero. And if the number, so personally, what's my number? Well, my number started at about 25% and it's substantially higher than that now. But it's still not 100. This is what I have to tell, because it doesn't have to be. When you have an asymmetric opportunity like Bitcoin, you don't have to be all in.
So you've described my situation exactly. Over the last few years, it's evolved obviously because of the gains. It becomes a higher percentage. Decide how to adjust. And I've said 2030. I believe Bitcoin will be at $1 million plus, and clearly see it the same way. And but I probably the one, you said a lot of things that I hadn't, you have clarity of thought that I love to get to the same place. The CDS idea of basically looking at insurance spreads on the traditional system as a measurement for where this is going as it relates to Bitcoin adoption is something that I want to spend more time.
I'd love to show you offline my calculation very simply on the United States and how I get to a valuation of Bitcoin just on the USA of over 400,000 per Bitcoin, which is to say you get all the other countries in the world for free. So it's just simple math. I say grade 11 math. Okay, maybe it's grade 12, grade 13. It doesn't matter, guys. Understand how credit works and the reality that's only mathematics, that as your interest expense grows, if you're not paying that, that's called a debt spiral. And that's where the USA is right now.
Yep.
But so is Canada, my home country, and so is every other nation in the world is exactly in this debt spiral. There's gonna be things that fly off, and eventually there'll be a G7 country that defaults.
Yeah,
I hope it's not Canada, but chances are it is, because we're just a rounding error. Now, here's the cool thing.
Japan worries me.
That one is different, but I agree with you as well. It'll be a cataclysmic explosion of 3 or 4 of these all in succession. And what do I know for sure? Okay. I don't want that to happen quickly. I want to build the alternative system. And here's the crazy thing. You know how Canada could rescue themselves, Bill? We could turn around and price all our natural resource energy in Alberta, where we have more energy resources than Saudi Arabia. Did you know that Canada has a larger, but it's primarily hard oil or tar sands or whatever. That being said, it doesn't matter. Heavy oil is the word. It doesn't matter. If we price our natural resources in Bitcoin and start charging the world for our products in Bitcoin, we can build up a treasury that can save our entire country.
Yep.
I don't think our politicians are smart enough to do that, but that would be my hope.
I was in UAE a few weeks ago for Satoshi Roundtable, and I had a discussion with somebody involved in their nuclear industry, and they are planning to mine via the power plant.
Perfect.
And we had this discussion about, how they should think about the finance ministry, who really didn't understand our world yet.
Yeah.
They were starting to really think about it.
Okay.
And I said, well, think about it. If you basically use the nuclear power plants and you have one offline, one online, and take the one that's offline and basically use it as a lever for providing energy to the grid. And when it's offline, effectively,
it's a dial.
It becomes the dial for what equates to printing free money, right? Because you now have a printer in the basement, which is the cheapest money printer.
Let's be careful, because it's not free, because you had to build the capital expense to build that.
It's already
base load. It's base load, correct. If you look at it as sunk costs, you're 100%.
Yeah, if they were starting from scratch, it would be a different discussion, but they've already built it.
Okay, if they've already built it, then it makes a ton of sense. And we're trying to do the same thing in Canada, because we have small modular reactors, SMRs, that we lead the world in the technology there. So, hey, look, it doesn't have to be oil sands. It could be SMRs. I don't know what it is, but please, Canada, do some math, because you know what? Our idiot prime minister who says budgets balance themselves. No, sir, they do not balance themselves. Okay. So that is the biggest risk, is you have a clown who is managing the budget when in fact, we need someone with fiscal responsibility and vision for the future for the kids.
Yeah, when they wrote "Send in the clowns," I think that's who they were. That's who they were talking about.
Yeah.
All right. So this has been awesome. I think people are really going to have a lot of questions and want to dig in. Maybe we'll do a Spaces follow up and
please
questions have. But it was super fun. So Greg, it's been awesome getting to know you here a little bit. I do feel like I know you because I've been watching you on Spaces. I saw your interview with Natalie's a good friend, and I think you've been a great steward of bridging the gap between traditional credit and Bitcoin and why we're going where we're going. So thank you for what you're doing. I know you don't get paid for it, and you enjoy it, but I think the public is learning a lot, and at least as one sliver of the public, I'll express my gratitude.
Well, back at you, sir, because we're all trying to educate and bring just our experience. I'll just end it this way. I feel that I benefited from the fiat system. I'm trying to give back to leave the world in a better place than when I arrived in it. Bitcoin is that solution. Bitcoin is freedom. It's perfect money. It's perfect collateral. And it's not just money. It's actually information. It's power. It's energy. It's everything that an engineer loves, which is what I am at my undergrad. So thanks for having me. I look forward to taking this to the next level. I'm part of a pretty exciting opportunities fund, a Bitcoin opportunities fund that's just getting launched. So all of these things mean that we're working and we're rowing in the same direction. So I'd love to talk to you about it more.
Yeah.
I really do appreciate the invite onto your show. Thanks so much.
And for people who aren't following you, I assume Twitter is probably where you're most active. Where do they find you on Twitter?
Isn't that crazy? I actually have a couple of followers on Twitter. My handle is @Foss, Greg Foss. So FOSS, GREG, FOSS.
Yeah.
And yeah, I tweet.
And everyone needs to follow Greg. You have a great following. Follow him on when he goes on Twitter Spaces. It's always interesting. So yeah, definitely.
You're the man. All right, sir. Well, thanks again.